This visualization represents the traditional banking core system. For decades, it was explicitly designed to process standardized, numeric financial data at extremely high speeds. That architecture is now colliding with a massive influx of unstructured, non-financial data. Markets and regulators are injecting variables like Scope 3 emissions estimates, corporate transition milestones, and biometric identity markers into the financial system. Financial institutions are suddenly expected to underwrite non-financial realities. They have to price climate exposure and measure social inclusion, but their legacy systems lack the native vocabulary to parse this incoming data. Many institutions respond with surface-level digitisation. Electronic workflows and standalone green loan apps improve operational efficiency, yet they fail to provide the strategic depth required to integrate these complex variables. Bolting sustainability applications onto legacy financial infrastructure creates friction under supervisory scrutiny. Processing non-financial risk requires a total architectural rethink. Solving the disconnect between legacy systems and non-financial data requires a tripartite model. This architecture converges three distinct pillars into a single operating foundation. First is the FinTech layer. This provides the sheer infrastructure required for high-volume data ingestion and automated processing at scale. Second is the ESG logic layer. This integrates the specific non-financial risk variables and opportunity classifications directly into the bank's decision-making matrix. Third is governance. This acts as the containment field around the technology, providing institutional control, clear decision rights, and auditable evidence. In this pipeline, ESG value is strictly cumulative. If any single pillar fails at any stage in the banking value chain, the ultimate regulatory reporting output is corrupted. We can trace this data pipeline across the linear banking value chain. The absolute starting point for data integrity begins here, at customer acquisition and digital onboarding. At this intake node, the primary mandate is social. The objective is driving financial inclusion, granting access to thin-file small businesses and historically underserved demographics. To achieve this, banks deploy digital identity infrastructure and API connections to pull alternative behavioral data, such as merchant payment histories, bypassing the need for traditional paper documentation. This creates an immediate governance tension. The institution must balance the drive for frictionless digital access against the rigid requirements of anti-money laundering and adverse media screening. Looking inside this node, we see why precision matters. If a data packet miscategorizes a client's sector or ownership structure during this intake phase, it creates a silent error that will propagate through the entire bank. Every piece of downstream data lineage relies entirely on the successful calibration of this initial compliance gauge. A sustainable banking model cannot widen access by weakening its controls. Inclusion without strict governance at onboarding generates persistent, long-term compliance vulnerabilities. The data packet moves to the credit assessment and origination node. This is where ESG classifications become financially material to the balance sheet, and simplistic logic fails. Using exclusionary algorithms that sort businesses into strict green or brown categories is useless when underwriting real-world economies. Real impact requires transition finance. Financing the gradual adaptation of legacy energy and real estate sectors accomplishes far more than restricting capital exclusively to pure green assets. To evaluate these transition pathways, banks deploy digital lending engines paired with AI-driven scenario modeling. These AI models ingest environmental risk indicators and transition readiness metrics, using them to dynamically alter loan pricing logic and customize covenant design. Handing underwriting authority to an algorithm requires a paramount governance mechanism, model explainability. If an AI credit engine penalizes or rewards a borrower's transition plan, the bank must possess the architectural ability to document and defend that exact logic to regulators. In sustainable finance, black box AI is a liability. Within the portfolio monitoring node, sustainability functions as a dynamic classification. It relies on continuous technological oversight to remain accurate. Environmental and social conditions are highly dynamic. Post-disbursement, borrowers miss their transition targets, and entire sectors face rapid regulatory shifts. For complex trade finance, banks utilize blockchain and distributed ledgers. This creates immutable multi-party traceability to ensure funds are actually used for their stated environmental purpose. Regulatory technology, or regtech, establishes automated workflows that continuously scan these dynamic data streams against the original loan covenants. The vital governance mechanism here is the establishment of strict, predefined alert thresholds combined with clear internal escalation routes. Consider a critical failure scenario. The system detects a borrower diverting funds away from agreed-upon sustainable activities. Originating a green-labeled facility without the FinTech infrastructure to actively monitor its milestones creates an immediate greenwashing vulnerability, destroying market credibility. We reach the final pipeline stage, reporting and investor communication. Here, the bank's internal regtech attempts to interface with external supervisory technology. Regulatory reporting is not a marketing exercise. It is a rigorous operating model stress test for the entire institution. The external threat landscape is changing. Supervisory authorities are rapidly deploying advanced tools, known as subtech. Subtech utilizes advanced data scraping, cross-institutional comparison, and anomaly detection to continuously monitor the stability of the financial system. Regulators no longer accept static, narrative PDF reports. They demand continuous, machine-readable data pipelines. This creates the ultimate test of a bank's internal architecture: the ability to trace a specific reported ESG metric flawlessly back to its original source data. If data lineage is broken anywhere in the previous nodes, the bank fails the assurance test. That triggers regulatory remediation and acute reputational damage. The value of external reporting relies entirely on the internal governance discipline established and maintained throughout the preceding value chain. Looking at the entire journey, data must survive intact. It connects the final regulatory report directly back to the initial digital ID check. Institutional control isn't a final phase. It's an absolute boundary wrapping the entire life cycle. The tripartite model scales this successfully. FinTech provides the necessary processing volume and digital speed. ESG defines the critical non-financial parameters, identifying transition pathways and material risk variables. And governance provides the auditable evidence, ensuring model explainability and rigid institutional control. Deploying advanced technology without that strict governance merely produces algorithmic bias and misclassification at a much higher velocity. Sustainable FinTech delivers a strategic advantage when it functions as an integrated operating model, one that successfully reconciles digital speed with unyielding institutional control.